Welcome back to the Investor Professor Podcast. This is Dr. Ryan Peckham, and this is episode 126. On today's episode, we had a lot of earnings this past week. Let's see how it shook out. There's some fabulous earnings going on out there, and there is some even better responses from the market. So let's take a look at that. And then let's also talk about what makes a great business and how much should we pay for those great businesses. All on today's episode. So get your mind right and let's get to work.
You dropped this.
Welcome back, everybody. As always, we are busy here. We are busy in the market. There was a lot of stuff going on this past week. We had earnings, and then we also had the Fed meeting, and then we had more earnings. So Tuesday got started with Microsoft reporting earnings. AMD reported earnings. And so initially you see those kind of pull back a little bit, finish the week up, but initially they pulled back. Wednesday, we had the Fed meeting where Jerome Powell said that he wasn't going to raise interest rates. And more importantly, he said he wasn't going to drop interest rates. And he said that he didn't see them dropping rates in March, which is what the expectation was. And so middle of the week, you see the market sell off very, very harshly on Wednesday. And then it comes back. So what's going on here? Well, remember, I've mentioned numerous times that 50% of all the trading that goes on in the market is computerized. And so those algorithms key off of everything going on based on what the rate's supposed to be. It goes in there, it changes the calculation. It tells the algorithm whether to buy or sell. Probably more information than you want to know. So the market sells off, and then all the humans go, well, I mean, geez, it's not really that different than what we thought it was going to be. These companies are getting beat up. They're probably going to have really good earnings, and then they go in there and start buying it again. And then Thursday, you have Amazon report, great quarter. Meta reports, fantastic quarter that we'll talk about in just a minute. And then Apple reports, so quarter. So Meta reported fantastic quarter. Incredible growth. They also announced a 50-cent per quarter dividend and a $50 billion share buyback. And so because of that, on Friday, Meta was up 20%, which was $80 a share, to $475. But let me just put this into perspective. This is the largest single day market cap addition to a company ever. So Meta added $197 billion to the value of their company in one day. Which is just absolutely incredible. Normally, the average volume for Meta is 17 million shares, and on Friday, close to 85 million shares traded. So Mark Zuckerberg getting cost under control at Meta and kind of not just pouring so much into the metaverse, giving something back to shareholders, which, by the way, he is a shareholder. That dividend that he's doing is going to create $700 million for himself in the form of a dividend, which is pretty incredible. And I believe today I'm recording this, I think it's the 20th anniversary for Facebook, which is the company is currently worth $1.2 trillion. So it just shows you how different the world is than it was 20 years ago when Facebook started, and shows how quickly a company can rise to dominance. And so you look at Meta, you look at Amazon, who was able to get its cost under control, driving profit up. And so these companies that we've been discussing for the last couple of years, there's something important for you to realize here, which is not only have they lowered lowered their expenses, cut expenses, but they've also increased sales. So it's like, this juice that's being added where they're not only are they raising, their revenues rising, their sales are rising, but their costs are going down, which expands their profit margins and really drives up the stocks. And so we're seeing that on Meta. We saw it on Amazon, Amazon is still not back to its all-time high. Although this week, if the market continues to run, I do think it'll get there. It's not that many points away. And so you look at Apple. Apple, not a great quarter. Not horrible, but not good. They're having trouble in China. Chinese consumer isn't spending as much money. Their economy's struggling. You see that, Chinese government's trying to prop that up. And so, we'll see. I'm not worried about Apple. I mean, my goodness, this weekend I'm just seeing, just constant videos of people wearing the Vision Pro. So it'll be interesting to see how that Apple Vision Pro works. I mean, the price tag of $3,500 is going to scare a lot of people away probably, but there will be some diehards. It'll probably, most of the time, Apple products, man, they sell more out of the gate than people expect. So that will be interesting to see. Just a completely different price point than Meta and the Oculus glasses, though. So, we'll see what happens with these heavyweights. And so it begs the question, we talked over the last 18 months, we've talked about, buying these companies, investing in these companies. At the end of, 2022, you could have gotten, Amazon for $98. Meta would have been even better. Of all the big companies that we've discussed, me personally and for my client base, I probably invest in Meta less. I know I invest in Meta less than all the others. So you look there, but being exposed to these companies, I want to talk about what makes a great business. And then also something I've mentioned on this podcast before is, would you rather be the person who bought at the top or be the person who sold at the bottom? And how difficult it is to time the market. So you look at the last 5 years of Meta, and on August 1st of 2021, it was $380 a share. And then it gets absolutely destroyed over 2022 and goes down to $93. And then from $93, it has shot up to where it is now at $475 a share. Now, there is a investment bias called propensity for maximization, which is basically me looking at this chart going, hey, if I would have sold Meta at $379 back in August of 2021, bought it back at $93, and then held it today, I'd be doing great. Well, yeah, everybody'd be looking great. Hindsight bias, everything looks good in the rearview mirror. But it does show, when you sell out of a company, you have to be right twice. And I know I've mentioned this before. You got to be right selling it out. And then you have to be right when you buy back in. So you got to be right. You got to be right selling out on the downside, and then you got to be right buying it back and then holding it to come back up. And so, you got to be careful with that game. I mean, I do know people who are they sold out when it wasn't good in 2022 and they still haven't put their money back. And so when are you going to put your money back? And the thing about it is we invest in good companies, right? That's the thing. We want to invest in good companies. So investing, when you really break it down, is you are investing in the future profits of the business that you are investing in. So if you believe they're going to have a good future, it's more about, okay, this company, I see it, I think they're going to have a good future. What are those future profits worth today? And do I think I'm getting a good price for it? And so when you think about it from that standpoint, it's like, okay, how do I locate a great business? What constitutes a great business? And then what's a fair price to pay for it, right? So we go back, Charlie Munger, Warren Buffett, where basically it's like, hey, it's better to buy a great business at a fair price than it is to buy a terrible business at a wonderful price, right? I mean, so you think about those things. And so for me, the way I do it, Other people do it differently. I pay attention to earnings per share. I want to know how much is this company growing. Earnings per share, it's not that difficult of a number to go find. Most people can understand it. You go to the income statement of any company, and on that income statement, it'll show you their earnings per share. And so you want to go back, you got to look at a history of what their earnings per share are, and you want to see, is that earnings per share growing? Is it methodically growing? Is it growing at a steady rate over time? Or is it decreasing? Or is it bouncing around like crazy, right? If it's bouncing around like crazy, that means maybe their business is pretty sporadic. Maybe it's cyclical. And so you're just training yourself to go look at these numbers. And I know this might be more details than a lot of people want, but this is the way you go find a good business. And you think about, okay, what makes Meta a great business? Well, let's break it down. There's a lot of people on their platforms, right? So Meta owns Facebook, they own Instagram, and they own WhatsApp. And there's a lot of eyeballs on that every single day. They get paid from marketers, right? You're not paying for Facebook, Instagram. So if you're not paying for the product, you are the product, right? So advertisers love to pay them because they can say, hey, I want a boring 42-year-old white guy to advertise to. And they say, hey, I know a bald guy that meets that criteria. Here you go. Here's his Instagram feed, right? So they advertise right to me. And so, but the other thing too about like a Facebook or Meta is, what are their costs? Well, when you look at like Facebook, Meta, geez, I'm never going to get this right. When you look at Meta compared to like ExxonMobil has to have a lot of property, plant, and equipment. It costs a lot of money to get oil out of the ground. It is a very capital-intensive business. Whereas Meta, they really just need some servers. They got to have a building that has those servers, and they need a lot of air conditioning to keep those servers cool, right? And so, side note, sneaky stock pick here, Carrier, who does all the air conditioning, very good pick. So you look at the cost structure of somebody like Meta, it's completely different, right? So we now have technology companies who are driving so much revenue and profit, but yet they don't have the expenses of the big industrial companies of the early 20th century, like, railroads and automobiles and utilities and, Caterpillar and, all those kind of companies. So it's completely different. So we look at the earnings per share. We want to see how fast are they growing those earnings? What's the growth rate on those? And can we, with any kind of reasonable expectation, expect those profits to continue to rise into the future? And on some of these big technology companies, we can. And, Amazons of the world, I mean, when they get down to everybody, when Amazon gets to be able to have 1-day shipping, think about how many people are no longer going to stop on the way home because they can wait a day, right? I mean, I'm so worried. I would be so worried if I was Walgreens, CVS, those kind of businesses. I would be very worried if I was an executive in those type of businesses. So again, going back to earnings per share, looking at that growth rate that they have, can we carry that forward? This is where time value of money comes into play. I don't think I can accurately describe a time value of money calculation, just with my voice here. But what you want to see is okay, how quickly are they growing their earnings? And you want to, if you can get a company that's growing their earnings at like 15%, 20% versus a company that's growing them at 5 or 10%, I'm telling you, it's about the future. It's not about the past. One of the mistakes that, investors make is they go look at an old stock chart and they go, oh, this company did great back when, but that doesn't mean their future is the same as their past. So these growth companies where you see them growing earnings at a fast pace, if you can reasonably expect that to continue, you need to take a hard look at that those kind of companies. So the earnings per share is what's going to guide you, bar none. And this is, you hear something called a value trap, which is I want to invest in a company that has a low PE ratio. And, you get a company where maybe they had a good history, but there's no catalyst for them to grow in the future. You got to have a catalyst. And so you look at the populations, Meta has done a good job of, having these different platforms that have different populations on them, right? Like different generations. Every generation kind of wants their own social media platform. And so, you look at that, and that's where eyeballs are going to go. Same thing for Amazon, where you look at, habits are sticky. And a lot of people changed their habits during COVID. A lot of people signed up. When you look at Amazon's numbers, and I mentioned it earlier, they're not even at their all-time high yet. And you go back and look at how many more customers they have today versus when they were at their all-time high back in 2021, and you see how much they've lowered their expenses. Amazon Web Services is starting to re-accelerate. I mean, things bode well for these companies. And I've heard little quips, and you see these articles that compare these companies to 1999 and the tech bubble bursting, and it is not the same. It is, I'm telling you, it is not the same. In 1999, I remember it. I was early in my freshman year of college or sophomore year of college. I mean, these were companies that if they had a website, people were giving them billions of dollars. I remember driving around Austin when the tech bubble burst, and there were like Ferraris and Lamborghinis for sale in grocery store parking lots. There were a lot of companies back then who were like had shell, or they didn't have any earnings. And so 2022 is more reminiscent of that, when the Fed started raising interest rates and all the companies that didn't have any earnings yet went into the absolute toilet, and a lot of them are still down in there. And so, but when you look at, man, even Google, whose quarter wasn't great, but it ran up into the quarter. You look at Google, you look at Amazon, you look at Microsoft, you look at Apple, and you look at the amount of money they are generating. I mean, you start comparing other companies to them, and you honestly start going, what's the point? Because they are making so much money. They're making more money than in any time in world history that any company has ever made. I mean, it's absolutely incredible. And so, are these stocks going to continue to run? Well, I mean, as long as they keep growing profits, they will continue to run. But it is, I mean, it's just, it's hard to think about these companies growing this fast when you look at the size of them. Because, everything would tell you that as a company gets larger, it's harder and harder to grow at that level. And that is true. I mean, you look at, Apple. I mean, it's hard to sell somebody another iPhone. I mean, but they still, Apple, their services are growing, with all those iPhones in circulation. And I know I've mentioned this already, but like with that many services, with that, with those many phones in circulation, there's a lot of services that they can be looked at. Another great one to look at that's not necessarily the same, but just go look at Costco. Go look at, if you go to Yahoo Finance, go to the, here, I got to describe this better. So if you go to Yahoo Finance, you type in cost, C-O-S-T, that'll bring up Costco. You'll see, it'll take you to the summary, which will show you the stock chart, everything like that on the kind of middle left. If you go across, you can look at financials. You click on financials. The first one that comes up is the income statement. That's the one you want. You scroll down, you see the breakdown. You'll see earnings per share. And you'll notice that in 2020, Costco's earnings per share were $9.05. And this past year, they were $14.18. And Costco is methodical as far as growing their earnings. And they're different from other retailers because they're a club, right? Everybody has to pay, a membership fee, which gives them a great base of income. Just really allows them to kind of have a different, a different kind of, what's the word I'm looking for? Different foundation than other businesses. And so, when I'm thinking about businesses, I'm thinking about what's the competition? What's the future going to be? What is their advantage over other businesses? Why would somebody do business with them versus somebody else? What does their existing customer base look like? Where are they in the business cycle? I look at, Chipotle and how well they've done. I mean, Chipotle basically poisoned people. People don't even care. And they're like, hey, fix it, come back. We look, if you look at Kava, which is another kind of Chipotle type model. I wonder, I've been looking and doing research on, do I think Kava is going to look like Chipotle? So, you take these great businesses, you look what makes them a great business, and then you have to look around the world and try to find other businesses that look like them. So Amazon, great business. Help me find Mercado Libre in South America. All of these things like, AutoZone, great business. Who competes with them? Are they as good as them? Waste management, who competes with them? Who wants to get into the waste management business, right? Union Pacific. I mean, just all these companies that we've discussed. I mean, you want to know, are they a good business? What's the competition? And then, you look at a business like, I don't know, General Motors. Expensive business. Constantly takes money. You look at them compared to Ford. They're constantly competing. They're competing with all the other automakers. Small profit margin. Hard to get ahead. Hard to stay ahead, right? Just a tough business to be in. AT&T, Verizon, T-Mobile, all of them. Very, you go from 3G. Okay, great. Oh, now we have 4G. We got to repull the line. Oh, now we have 5G. Oh, gosh, we got to repull the line. We got to beat Verizon to your alley to pull the line for fiber. I mean, you're just constantly having to feed these businesses money to stay competitive. The airline business, do I have to continue? A completely very difficult business, right? There's easier ways to make money. There's easier things to invest in than some of these very competitive businesses where it's really hard for somebody to dominate those businesses. So don't overthink it. Think about businesses that you use that have a competitive advantage. That it doesn't mean a great business does not mean they're not going to go through rough times. Meta went through rough times. Amazon went through rough times. They will go through lull periods. But is the business good enough that they can come back, they can recover when the market recovers, when the economy recovers? They're going to come out on the other side. So the other point I really just want to, just leave you with here is great businesses don't come around all the time. Every generation only has so many great businesses that they can invest in. I mean, Exxon was a tremendous business for a very long time. I'm not saying it's a bad business now. I mean, we're still going to need oil, great dividend, all those kind of things. You might just not get the growth that you got in the 60s, 70s, 80s, that kind of thing. But a tremendous business. Every generation is going to have a handful of businesses that is going to change that generation, change the world. And I'm telling you right now, you got to lean into those companies. Because they just don't come around that often. They do not come around that often. So everybody's always saying, I'm trying to find the next this or the next that. And I'm like, hey, that business is here right now. Why don't you just buy that business? It doesn't mean that the future is going to be any different. I mean, go look at in businesses that are also protected, hard to get in. Go look at Visa. Go look at the stock charts of Visa, MasterCard, and American Express. I mean, those things look like tech companies, hard to get in. How do you become another credit card processor? It's difficult. It's not easy. You need a lot of scale. We've talked about American Express. Over the last couple of years, their fastest growing card holders are millennials and Generation Z and, all those. So, I mean, to me, that says, man, they're going to have a lot of years of people using those credit cards. So this week, think about great businesses. Which ones do you own? Think about what makes a great business and start looking for those kind of companies to lean into and invest in. Buy, if you want technology companies, go buy some shares of the QQQ, right? Follows the NASDAQ. You'll get all these companies that we discuss. I mean, you want to make sure that you own, the Dow Jones ETF, DIA, the S&P 500, SPY, and then the NASDAQ is QQQ. Gives you a nice foundation for your portfolio, great pillars for you to build upon. And so from there, we achieve financial well-being and then financial independence. So great businesses, They don't come around, man. You gotta hold on to them. All right, that's enough for this week. Hope you had a great week. Don't mistake activity for achievement, as we always say, and I will see you next time. Have a great week, everybody.